Welcome, everyone. I'm happy to talk a little bit about a recent paper that I co-authored with Sebastian Steuer that deals with many aspects that are relevant for the community that is watching this. We deal with the role of disclosure in green finance. And the gist of the paper essentially is that, first of all, we survey all the transparency-based regulatory concepts that in green finance that we see around the world. And what we mean by this is we look at the regulatory interventions that are executed globally and can be categorized essentially in two ways. They either require the disclosure of raw data on climate impact relevant aspects of economic activity, or they can also come in the form of a label, which means essentially that there is a normative statement behind the transparency requirement, which says some requirements that we see or some economic activities that we see fulfill the labeling requirements and are therefore deemed to be environmentally good. And these two forms of disclosure, so both raw data disclosure and also labeling, can occur on different levels. It can occur on the level of economic activity, and it can also occur on the level of a firm, meaning in the context of capital markets of an issuer, or it can come at the level of the portfolio, particularly with regard to investment firms that provide these investment opportunities. And we survey the global landscape and find that the initiatives are pervasive. And then we turn to the quite interesting question whether this idea that enhanced transparency will ultimately lead to more favorable financing conditions for green activities and therefore can lead to market discipline that spurs the transition to a net zero carbon emission economy can actually work. And there we look deeply into the finance theory, asset pricing theory, and find essentially that both financially motivated and non-financially motivated investors can indeed prefer green assets over brown assets or dirty assets, as we call them, meaning that indeed this increased demand will have a price effect that automatically leads to more favorable financing conditions for green economic activities on each of the levels that we just sketched. And therefore, we believe that there are stable equilibria, at least plausibly they exist, with more favorable financing conditions for green assets than dirty assets. And this idea is, of course, consistent with the regulatory concept that underpins the transparency-based regulatory interventions in green finance that we see around the world. And we also survey, or we also investigate whether there is a role for regulatory intervention, in particular with regard to mandatory disclosure requirements, either with regard to raw data or with regard to labeling. And we find that, yes, indeed, there is such a rationale for this intervention, simply because the standardization, which is important to make the raw data that is disclosed or the labels that are attributed to certain economic activities or firms or portfolios, are actually comparable. And this standardization has the properties of a public good. Therefore, market forces will typically fail to provide an adequate standardized regime. And we can also observe this in various dimensions in the real world. So there's empirical evidence that indeed standardization through private sector agents fails. And in the last chapter, we simply ask whether the costs associated with such a mandatory disclosure regime are worthwhile. And we find that obviously there is no way of really quantitatively estimating the cost benefit trade-off. But on the other hand, we think climate change is just too important an issue for humankind so that we should simply give it a shot and therefore advocate that disclosure requirements should be introduced around the world.